This episode is brought to you by 180 Markets, where it is our goal to bring every individual, fund manager, family office, or any qualified investor access to Australian Stock Exchange capital raises. If you are ever interested in how to access ASX capital raises in a super simple way, 180 Markets is for you. The sign-up process is easy. You just upload your ID, proof of your investor status, and your current brokerage account information. The settlement of shares goes right into your existing account, and you can access our very next capital raise. If you're interested in free, easy access to thousands of ASX capital raises, including placements, IPOs, reverse takeovers, and more, check out 180markets.com.au. Welcome yet again, another edition, 18 Minutes with 180 Markets. Friends, we're always taught to take risks. Be a risk taker. Get out there on a curve. That's what we tell all of our kids all the time. But friends, I'm also here to tell you, as a lifelong professional investor, the best investors understand how to take the smallest amount of risk for the biggest upside. Well, friends, I'm really excited that we have with us today just such a company that's in the middle of doing their IPO. It's exactly that. It is by and large an investment with a lot of upside that's already been de-risked. Anyway, enough with me. I know you want to hear from the company themselves. Andrew Sorensen, Managing Director, WA Kaolin, and he's going to talk to you all about what is the Kaolin market. Andrew, welcome to 18 Minutes with 180 Markets.
Thanks, Greg.
Andrew, everybody has a story and people invest in people as much as projects. Can you give the audience a brief background on yourself?
Sure. I got involved with this project back in 2006 when the founders, Offtake and Keith Snell, who purchased the tenements from Rio Tinto back in 1999, invited me to join them. So I invested in the project in 2006 and then was sat on the board for many years. In 2017, I joined the company as the CEO and have been operating the business here out of Kwinana since then. My background is in industrial minerals. I've worked in the industrial minerals space with a number of companies, most recently a company called the PQ Corporation. I worked for them for many years in the silicates and silica chemistry businesses.
Fantastic. So for those of us that are not as familiar with the Kaolin market, can you just give us a brief overview?
Sure. So Kaolin was pretty well unknown in the Australian ASX landscape until about 10 years ago, and since then there's been quite a bit of interest. But let me tell you about the Kaolin. Kaolin's a platy white clay that's used in the manufacture of a broad range of industrial uses, things like paper, packaging, ceramics, fiberglass, paint, rubber, you name it. It goes into everything, even into cosmetics and pharmaceuticals. So it's got a very broad range of applications. And it's a clay material. It's formed out of the degradation of granite. So granite over time degrades and forms kaolin and silica. So the kaolin material is mined. We have a very large mine here in WA, and it's one of the very few mines left that's a primary deposit.
Fantastic. And so I say another way of thinking about it is that this is a product that because it has multi-essential uses, there's always going to be some type of demand for the product as opposed to just an incredibly big boom and bust cycle. Is that a good way to say it?
Yeah. A lot of industrial minerals do suffer from that boom bust cycle. So they're very exciting minerals in that you can go on quite a ride with them, but also there's a lot of risk there. The Kaolin market is not like that. It's got a very modest but profitable compound growth rate of about 3.5%. going forward to 2027. That's through market research that we did with an independent company, Grandview Research. And that stable market has been something that's been repeated in the history and continues to be so. So while it's not exciting, it is very low risk and it's a good commodity to be in because of its stability in pricing.
Exactly. And now maybe drilling a little bit further deeper on WA Kaolin itself. Can you just describe, you alluded to it before that you have one of the biggest projects. Can you just talk about it a little bit?
Sure. Our mine is located at Wickerpin. That's 220 kilometres from Perth. If you like, it's about halfway between Esperance and Perth. Out there, Rio Tinto discovered this back in the late 90s, as I mentioned earlier, And we've since been developing the project, and we're operating a business mining that kaolin and delivering product to customers right now. The mine itself has a mineral resource of 640 million tonnes, and we've got a mineral reserve statement of 30.5 million tonnes, which gives us a 31-year life of mine. Now, when you take our inventory of kaolin, both in our reserves and resources, we've got 283 million tonnes of kaolin. When you compare that on a global scale, Imerys is the biggest company globally in the kaolin market. They have 16% of the global market share. And if you look at all of their inventory of minerals, kaolin minerals across the world, they've got 250 million tonnes. So in our single resource, we have more than all of Imerys's resources combined, which is really puts it into kind of perspective how big this resource is.
Absolutely. And I say, there are a couple of things is that number one, it's not going anywhere because it is so large. And number two, again, coming back to that theme of risk and reward, because you are already in production, you have de-risked this project significantly. But just to maybe step back for a little bit for our resource types of investors, can you just describe the infrastructure, kind of what's nearby, where are you on a cost curve and so forth and so on?
Sure. So one of the reasons that Rio Tinto chose this resource when they did their research back in the 90s was its access to services. It's close to rail, road, power, water, and townships, for employment as well. So that's a key part. When you look at the logistics of delivering product to the market, that's a key feature and something that we're very well served with.
Yeah, and then, part of being in production, you have already, so-called dealt with a lot of battles. Can you just talk about the offtake battle, if you will, because you have a significant partner that people may not be aware of?
Yeah, absolutely. So we built the plant in Kwinana and we've been operating it since 2014. And the strategy behind us building this plant was to de-risk the project. And we're going to do that by proving out a business model by delivering products at the right price points to our customers, securing offtake agreements. And the third reason for building the plant was to de-risk the scale up. So it was an easy step to go from where we are operating today into the mine site plant, which is going to be operating at 25 tonnes an hour. So in doing that, we've actually got our hands on some really good customers over the last few years. Those customers include customers in all the geographies we want to be in Asia Pacific and Australia, as well as all the target market verticals like fiberglass, paint, ceramics, paper, and so on. And we've secured offtakes from a number of parties. The biggest of those is a customer called Stanco. Stanco is a partner with us. They have written a 6-year offtake agreement for 432,000 tonnes, and that's been going to be distributed into the fiberglass market in China. Stanco are a privately held company based in Taiwan, and they've got a big network of sales offices all through China, and their main game is delivering products to fiberglass makers throughout China. So they're ideally placed to distribute our product for us in that market.
Right. So now, said another way, we already have your business, which is up and running and producing. You have an offtake agreement in place. You have infrastructure nearby. It really is an execution story, which I think fits in well with your background, because your background, as I'm sure you're well aware, is very much on the execution side. It's very easy to talk about it, but you have actually done it, which is great. And speaking of doing it, can you just talk about on the production side, where we are today versus that ramp up over the next, call it, 24 to 36 months?
Yeah, so another key to de-risking the project is a modular scale-up implementation plan. So right now we're running this plant in Kwinana at 5 tonnes an hour. The upcoming IPO is going to fund the expansion of our plant at Wickerpin. So we're going to build a plant at Wickerpin right next to the mine, and that's going to run at 25 tonnes an hour. Now that will deliver 200,000 tonnes of product to the market within 12 months. So that plant will be up and running by the end of 2021. Now let me talk about the scale up here, because it's a key risk that it needs to be managed. And what we've done is we've got a 5 tonne an hour plant running today. We're running the 25 tonne an hour plant is 2 12.5 tonne modules. So it's only a 2 a little bit over 2 times scale up from where we are today to actual full production at the 200,000 tons.
But we
And
get
there,
the 5 times ramp up, right? Because we're going to go from 5 to 25. Is that right?
that's right, but it's 2 modules. So
Okay.
there's two 12.5-ton modules that deliver that 25 tons an hour. So it's a little over 2.5 times what we're running today for each module. And there's 2 modules going into per stage. And then we scale up to another 200,000 tons. And the key feature about this second scale up is it's there ready to roll, and we're planning to do it in the 3rd year. And it's all based on the market penetration, and the positive cash flow out of the previous stage is going to fund that. So we're not going to have to go back to investors and asking for more money. It's all about funding the growth of the business out of cash flow as we penetrate the market, which absolutely de-risks those CapEx decisions going forward.
Absolutely. And I suppose maybe now is a good way to segue into the IPO, because us, soon to be shareholders, obviously are going to enjoy a lot of the benefit and frankly, a lot of the hard work that you've already done, so to speak. But I'm sure you're aware of that. Can you just talk about the IPO a little bit?
Yeah, certainly. We launched our prospectus with the ASIC on the weekend, and its exposure period is 1 week. So we're looking to open the offer next Monday on the 19th of October. And the offer is to raise $22 million by issuing 110 million shares at 20 cents each. Now, each share, for each share, you get half an option. So for every 2 shares that you purchase, you have 1 option, and that'll have a 25-cent strike price with a 3-year expiry period. So that's another sweetener for investors. And the money that we're raising will go towards the CapEx. We've already spent $2 million of the CapEx out of a pre-IPO raise we've done. So there's $16 million coming out of this IPO funding to go directly into CapEx, building that plant and delivering that capacity so that we can meet those offtakes from our customers.
Absolutely. Now, friends, for people that don't know, and Andrew, maybe can you explain a little bit? This company has been around for a while, where there really has been a significant founder-led investment that frankly is going to be side by side with us. Their skin is going to be in the game, or your skin, I should say, just as much as ours, and frankly, as proportionally way, way more. Can you just talk about that, how much capital you have already invested?
Okay, certainly. Well, as I mentioned, we purchased the tenements from Rio Tinto in 1999. So in that journey of 20 years, we've developed a lot of IP and studied the market and built the plant and de-risked the project. And in doing so, we've spent $42 million to date. So we've got plenty of skin in the game, as you say. And of that $42 million, probably around $22 million went into capital plant and R&D. So very heavily weighted towards delivering a de-risked project production capacity.
Yeah, absolutely. And I think that also, and I don't know if you want to share them, I'm sure there's some lessons you've learned along the way, especially because, so many companies that we see are in a nano stage of exploration and so forth, but really the rubber meets the road when you have to execute, and you've had to execute. Can you just talk a little bit about, at least to me, that's a massive difference in your CV and your founder CV. Can you just discuss it a little bit?
Yeah. So, I mean, we're used to building businesses. Both Alf and Keith have built many successful businesses over the years, and this one is the latest one for us. The important thing for us was to get the project investor ready. And in that, we mean de-risk to the point where we can invite the public to join us. And we start off, and it's taken us a while, as you say, but we've started off with building a small plant that was 250 kilos an hour. And we built that in Melbourne. Now, we took the decision to build another plant in Kwinana, the one we're operating today, at 5 tons an hour, because we thought the scale up was too far to go from 250 kilos an hour to 25 tons an hour. So we built this plant, and that did 2 things for us. It de-risked the scale up, and it also allowed us to bring on customers, get our product approved, and secure these offtakes. So that has taken some time and some money, but we're now in a position where the customers are demanding more product than our plant can produce, and we have to execute this project to deliver that capacity to the market.
Great. And also, can you just give bringing it back to maybe some numbers, what would be the net present value that you're looking at from the project at this point in time?
Well, that would be making a forward-looking statement, and it's something that I've been advised not to do. But it's let me say it's a very positive number compared to our EV. So when we list, our EV is going to be $56 million after the transaction, and when you compare that, it's many times above that is what the MPV is on in our project.
So quoting the great sage investor Ben Graham, there's a huge margin of safety. Is that a good way to say it?
Yes, absolutely. Yeah, very, very much so. And I think when you look at our comparables on the ASX, so there's a number of companies on the ASX who are listed, who are in Kaolin, and they have valuations. If you look at their EV to reserve and resource, there's companies like Andromeda and Suvo. Let's take Andromeda as a case in point. If you look at their EV to their resource, they're valued at around $3.20 based on numbers yesterday. When you look at our EV in this transaction versus our resource, we're at 9 cents. So if you want to call that a margin of safety, I would say that is very much a margin of safety.
And the quality of your product, as you said earlier, is very, very high. And the proof is in the pudding because you're already producing. So customers obviously do like the product, so to speak.
Yeah, I mean, the resource really differentiates us from our competition because of its high quality. It's very bright, and it's very low impurities. And customers in the Kaolin market buy on three things. They buy on brightness, they buy on least level of impurities, and particle size. And the first two are implicit in our resource. It's naturally there. We don't have to do any chemical bleaching or magnetic separation. We are low cost because our resource means that we don't have to do any of those things that our competitors do. And then it's just up to our process to separate that silica and deliver the particle size the customer wants.
Fantastic. And Andrew, just in closing, to sum it up for investors, as I said, to me, it sounds like, small risk for high reward, big margin of safety in financial terms, if you will. Do you have any closing thoughts for the audience?
Yeah, look, I think it's very important to understand that we as owners have got a lot of skin in the game. You've mentioned that, and it's very true. And the way this deal is put together, our execution, our rewards are calibrated to our execution because we have performance rights, and those things are not delivered unless we deliver this project on time, on budget, and delivering the EBITDA and revenue numbers that are very exciting. The owners are in this for the long haul, and what we've done is we've calibrated a dividend policy of 66% payout on NPAT, and we've done that because this is going to be paying dividends for our investors for the long haul. Secondly, as owners, we've agreed to an escrow period of 5 years, so just to demonstrate again that we're in this for the long haul. And when you look at the fact that our business doesn't require much capital to grow, we're able to pay these dividends as well as fund the growth of the business going forward. So it's going to be a very good ride for all of us.
Andrew, thank you so much. We very, very, very much look forward to investing, and thank you for your time.
Thanks, Greg.
Bye-bye. Thank you for watching another presentation by 180 Markets. Don't forget, if you want access to thousands of ASX capital raises, head on over to 180markets.com.au, sign up, and get on board for our very next capital raise. Thanks for watching.